Good morning, everyone. Welcome to this update for global stocks and commodities for the 19th of January. The edition this week is titled Why the Bulls Are Winning, as you can see, and I want to just touch on some things that are really standing behind that. So this is really more a perspective about the big picture drivers of the market. So a couple of things that I learned many years ago and always stay with me. And the first one is to look at the market through the lens of self-interest. So if you can look at what the major players, what's in it for them, then generally you're not going to be too far away from the truth about where the market actually goes. The second thing that I learned is that money flows where it's treated best. Now, both of those things, when you think about them, are pretty self-evident and pretty obvious. But the thing is that most people don't think about them. They get consumed by what the media is feeding it, by the biases in their head, and they just lose sight of the things that really ultimately drive the market. And the reason that I'm bringing this up is that with the S&P and global markets, the Australian market hitting new highs, everybody is, or not everybody, but a lot of people are starting to get concerned about the end of the bull market. And every time we get another advance in the market, a certain percentage get really concerned that it's about to come to an end. So I want to provide a perspective that I think is going to be really helpful in this particular video. There'll be the normal stock and commodity trend update. And Portfolio Analyst last week, I went through in detail the investment methodology that I use for selecting stocks, and also just the excellent progress that we've been making in the 10-bagger portfolio, which is part of that service. Now, just before I move into the body of this video, I just want to explain the first couple of comments. So money will always flow where it's treated best. If you stand back and look at where we sit at the moment, and have been for quite a few years, the 10-year US government bond is yielding around 1.8% at the moment. Yet the earnings yield, so that's not the dividend yield, but the earnings yield of the S&P 500 stocks is about 6.6%. And I think I mentioned that last week or the week before. So when you compare 1.8% in the bond market or 6+% in the stock market, it's pretty obvious where the money is going to flow. And so that, to a degree, overrides a lot of these other considerations about valuation. The reality is that central banks are just creating such immense liquidity that's going to flow to the asset classes where they get the best return. We've got a low return, low growth world. It's probably going to be that way for as long as we can see. It's been that way in Japan now for nearly 3 decades. So why will that not apply to the rest of the world? So if we're going to have a low growth, low return world, and central banks generating massive amounts of capital, then that capital has got to flow into asset classes somewhere, and it's going to flow into the asset classes that are giving it the best return. So to me, when you think about it, it's pretty obvious. But the masses are obsessed by the length of this bull market. Every week you read how long it's gone, how far it's gone, and therefore it must end. Or other people are obsessed with the backward-looking valuation measures, such as the CAPE ratio, or the massive debt burdens that are being amassed by governments around the world. And I'm not saying that is not going to become a problem at some stage, but at this point in time, it's not a problem. And what the masses are missing is the 2 points above about the lens of self-interest and money flowing where it's best treated. But they're also missing the fact that technology has changed the game. It's changed the game quite a lot. Technical disruptors, such as companies like Afterpay Touch and many others, are creating massive value by capturing market share, which in the early years is just not apparent. It doesn't show up on the profit and loss statement. It doesn't show up on the balance sheet in the traditional sense. And that's why people look at stocks like Afterpay Touch and shake their head and say it's ridiculous. but the value that they're creating is real. And that value will become apparent with an avalanche of profit that's going to drop to the bottom line in future years once the sort of the, call it a land grab if you like, is complete, the building of scale. You know, Amazon did it for many, many years, and look at them now. And that's what the market is pricing in. It's that ability to scale your business on a global basis very, very rapidly and then accumulate profits in the future that make it all worthwhile. And you've only just got to consider the evolution of Amazon, Facebook, and Google, and many others in the US over the last decade. People thought those valuations 10 years ago were absolutely insane, but look at them now. They're absolutely global dominating businesses that have become so good that some people are talking about the fact that they might have to be broken up. They've just become too successful, too powerful. So what's my message out of all this? A couple of points. Don't stress about whether the bull market can continue or not. It is just really a waste of time and effort. The second thing is just discard all the conventional thinking about what sort of stocks you should have in your portfolio at various stages of the economic cycle. A lot of people at the moment are, running for safety, and in doing so, they're piling into infrastructure stocks and high dividend real estate stocks, or supposedly high yielding dividend stocks that have been pushed to such an extreme that they're no longer safe. And the third thing is that you really need to focus on taking advantage of where disruptive technology is going and what it has to offer, because it's disruptive technology that's providing the pathway to outstanding returns in the future. Now, I've been following this theme for a number of years, but in particular with a public fund service that I run. Those funds are up 28% since January of 2019 by placing a heavy focus on just what I've talked about and pursuing the technical disrupting stocks that are a very strong growth story, a very high probability growth story, and the market is pricing those in. So that's the message of this week. So the overall global rally, the overall global reality, from my perspective, is that 2020 should not hold any nasties. Now, that doesn't mean that it won't be a bit volatile and we won't get a couple of corrections that could be 5 or 10%, or maybe even a little bit more. Who knows? But it's not going to change the primary trend, I don't believe, in 2020. What we've got is a Goldilocks setup. We've got economic growth. It is probably bottomed out in 2018, 2019, and there are certainly signs that global growth now is starting to turn up. It's probably not going to be anything dramatic, but it is starting to improve. And we're getting that without inflation. We've got all this central bank stimulus that's going into assets and pumping up asset prices. But it is not leading to inflation. And one of the primary reasons we're not getting inflation with all the monetary stimulus is because of technology. Technology is taking pressure off the economy. So we've got a setup that has been in place now for a number of years, and it's hard to see it changing. The second point is inflation does remain subdued, even in China, where obviously the monetary stimulus has been at the extreme end. The global PMIs, Purchasing Managers Indices, have stabilised and they're improving. So that's important, and that's being factored in now. We've got the Federal Reserve on hold. They're almost certainly not going to raise interest rates this year unless something very unexpected happens. And you shouldn't worry about things that aren't on the horizon and are completely unexpected, because they probably won't occur. So the Fed's on hold. They're already stimulating at the moment. It's not getting much press because people don't understand it. But they're actually providing tens of billions of dollars every month into the repo market to provide liquidity for the financial system. And they're just going to keep doing that. The Fed will provide as much stimulus as needed. We've also now got not the end of the trade war, but we've certainly got the diffusion of the trade war. We also had a 24, 48-hour flare-up in the Middle East, but those tensions also seem to have abated again now as well. Trump will want a strong stock market this year. If he wants to get re-elected, he needs a strong stock market. The history of the incumbent government in the US being re-elected when you've had a weak stock market is almost 100% against. So he'll do whatever he needs to do to keep the stock market strong and also keep the jobs market strong as well. So when you compare the earnings yield of the S&P, which is above 6%, and you compare it with the 10-year government bond yield of 1.8%, it really is a no-brainer. On top of that, if you look at the US dollar impact, all the signs are pointing for a lower US dollar, which is because Trump wants it, and certainly the smart money is positioned for a lower US dollar. That's going to be good for US competitiveness. It's also going to be good for US non-US growth, and particularly emerging market stocks. A low US dollar will be good for China and other Asian and South American stock markets. All right, fairly long introduction, but I think it's really, really important to have that perspective. So the S&P last week rose 65 points, 2%. Certainly has been an acceleration in buying in the last week or two. It's becoming a bit euphoric, and therefore in the short term, I don't believe it is sustainable. I think we'll get a pause. But please read that comment in the context of everything that I've just gone through. It doesn't change anything at all. And as you'll see when we go to the chart, if you consider the length of the consolidation, which went for nearly 20 months before the breakout, there's no reason why this breakout couldn't continue for 12 months at least, albeit with a few pullbacks along the way. Now, earnings season has started last week, predominantly with the major banks, and it was positive enough. We had certainly a lot more beats than fails, and the economic data is good enough. If you want to find some problems, you can find them, but the economic data is good enough to support the economy, the jobs, and the advancement of the stock market. That's the main point. The US dollar, 97.6, and it's consolidating just below its trend channel. And the 10-year yield was steady at 1.8%. So let's jump in and take a look at some charts. We'll start with the S&P first of all on a monthly basis, just to give you that big picture perspective. And you can see we certainly have had an acceleration even on the monthly chart in the last couple of months. Diving back to the daily, you can see we are now further above the blue 50-day moving average line than we've pretty much been at any stage. So you've just got to expect a little bit of a pullback, or at least a shallow consolidation at the very least. But frankly, I see that as a buying opportunity and not anything to be concerned about. Now, if we pan back and take a look, this is the previous consolidation, which started in January of 2018, and really we didn't fully really bust out of it until October of 2019. So as I said before, about 20 months. So if you look at the size of that consolidation, the runs that occur leading into a consolidation and coming out of a consolidation tend to be significantly longer than the consolidation itself. So if the consolidation was 20 months, then there's no reason why this next advance couldn't go for another couple of years. I'm not saying it will, that is not a prediction. I'm just merely making the observation about typically what a market does. When it consolidates for that long, you tend to get a breakout that runs for further and longer than what anybody believes is likely. So that's the S&P, and of course all the other indices are doing very well also. If you look at the US dollar, there's the trend channel. We've dropped out of the trend channel, as you can see, broken down here. We've rallied back to the trend channel, and we're still just sort of in a consolidation. but there's a couple of things that are favouring a lower US dollar. This advance really does seem to be rolling over now. We're getting lower highs and lower lows. Secondly, Trump desperately wants a lower US dollar. He's said that since 2016. And thirdly, the positioning of highly leveraged funds in currencies is heavily to the downside in the US dollar. That doesn't guarantee that the US dollar will go down, but it's a pretty good indicator. So it's likely that we may see some upward pressure on the Australian dollar. However, that's got to be offset by the weakness in our economy, the hit that the economy's taken from the bushfires, and the likelihood that the RBA could lower our interest rates as early as next month. So we've got these competing forces for the Aussie dollar. The net effect, of course, might be that it might just sort of hang around this 68, 69 area for some time, with local issues putting downward pressure on the dollar and the US dollar direction putting upward pressure on it. And net, it may end up going nowhere. Quick look at the Australian market. So here's our breakout. We'd been building up to this for some time. I'd been a disbeliever, as you know, in the ASX 200 breaking out, merely because, so this is 2007 peak, merely because I could just see so many negatives for our banks. But look, what has happened is that the Australian index has gone along with the rest of the world. Money has piled into it. Low growth stocks and stocks without a particularly compelling forward case, such as our banks and many other top 100 stocks, the money's just flowed into them anyway, and it's just expanded the PE multiple. Now that we've got a breakout, I won't make any suggestions as to how far it might go because, as I've said many times, I don't trade the index. I don't really pay much attention to the index other than in this particular weekly review. Okay, so Aussie stocks were steady on the dollar, 68 3/4. We gained 2% in our market last week on top of the 3% last week. But as I noted last week, and I note again this week, there are just lots of low growth companies where the multiples have extended beyond their historic norms. And to me, that is the greatest risk in our stock market. It is not the high growth technical disruptors. Yes, they'll be volatile, but in terms of absolute risk, I think there's a lot more absolute risk in the stocks that have got no to low growth that have just been pushed too high. And it was a huge week for the technology disruptors last week. As anyone that subscribes to any of my services know, it was probably the best week that I can recall in several years. So it's certainly, that performance is certainly validating the approach that I've been taking for a number of years now. Precious metals, gold was down slightly, just a couple of dollars to 15.57. And the status quo pretty much remains from last week. Gold should be precarious because of the overhang in the futures market, but it's not. It's just defying the norms, and therefore you've just got to be open-minded. That's what I talked about at the start. You've just got to embrace the fact that things are evolving, things are changing, things aren't always as they used to be. So we've had a breakout in gold. We then got a retracement, but now support is holding. But it's holding at a level that is much higher than what would be normal. That's the point. Normally the retrace would be much deeper than what we've seen, and that's why gold still is a little precarious. It's not a great risk for reward, but that doesn't necessarily mean that it will fall. Precious metal stocks are starting to behave just in the latter half of the week a bit more positively than the underlying metal, and I always look at that because the gold stocks tend to lead the metal in both directions. So tactically, I remain a bit cautious, mainly because of the overhang in the futures market. It means that most of the buyers are in, but not as, there isn't that much capacity for new buying unless new buying comes in. And as I showed last week, central banks have certainly stepped up their buying. So that is probably what's sort of stabilised this market at a higher level. But I really would prefer a bit of a correction. It'd just sort of clear the air. Aussie gold stocks have been a bit more volatile and they've offered trading opportunities. So I think rather than taking a set and forget on Australian gold stocks, it certainly has created some trading opportunities. So, sorry, let's look at the charts on gold. So we'll look first of all at a weekly chart, and you can see that we've got this quite strong uptrending channel. We had a breakout, a major breakout that occurred in the middle of last year, and we then got a consolidation, and we then got another breakout that occurred basically a couple of weeks ago. The week before last, we zinged up to 1611 before consolidating back again, but we remain in this very steep uptrend. So that's the big picture at the moment. Now, if we zero in a little bit more on the daily, you can see a little bit more clearly the breakout that occurred just recently. So the breakout that occurred on the 3rd of January, and then we've retraced, so that's normal and healthy, but we've been able to hold this support at a very elevated level. We're way above the 50-day, and we're even further above the 200-day. So at this stage, it's still a market to be involved in, but you need to take advantage of dips to add to your exposure. Other commodities, copper raced ahead to 283. Crude oil was pretty volatile, but it did close at 58.69, mostly about currency movement. Here's the copper chart. So we've been in quite strong uptrend now since November. And there's the nickel chart, which has really stabilised. So wrapping it up, my final thoughts. I think in various ways, I've been saying pretty much every week that success in the stock market is a lot about your psychology. And there's many aspects to that. And one of them is just be aware that we all tend to suffer from a confirmation bias. Our attention tends to be drawn to information that is supportive of what we already believe or what we already think should happen. And it tends to ignore other possibilities as well. So what many investors have been doing for a decade, since the GFC, has been massively to their detriment, because they've been looking for information. They've been fundamentally nervous and they've been fundamentally distrusting of the market. And so what they've done is to look for information that that confirms that sort of underlying belief pattern and ignores other possibilities. So therefore, the continual examination of the bigger picture is just indispensable in my view. If you are taken in by what the media is telling you or what your belief system's telling you, then it's likely that you're being misled in the market and the decisions that you're making. You need to follow the primary trend and just downplay the noise that's either inside your head or outside in the external environment, and try and do what I highlight nearly every week in one format or another, and that is to just identify high growth, high probability, high quality stocks, have the discipline to wait and purchase them on a dip, and just sort of manage them accordingly, and don't get put off too much by the short-term volatility. And if you can do that, I think you can be very successful. But for most people, the difficulty is in knowing what is a high quality, high growth, high probability type stock. And most people don't have the time to do that. So you need to align yourself with someone that can do that for you. That is the case for most people. In that vein, the service that is started in January of last year, and portfolio manager has a progressive return so far of 28% since January last year. So that's working very nicely. And there'll be some more information coming about that in the very near term. Portfolio Analyst this week, I'm just going to be reviewing what was a very powerful week for the 10-bagger portfolio last week. And there also will be another, I think, very interesting local stock that that has a lot of promise. So that's it for this week. There's my contact details for any non-members, and I'm sure it'll be another highly interesting week coming up. That's it. Talk to you next week. Cheers.